Welcome back to the 80 Money Show. On this segment, I'm joined by Hemant Rustagi of WISEINVEST Advisor, as well as Amit Kukreja, founder of Amit Kukreja Advisory, to discuss a few queries we have received from our viewers about their portfolios. Good evening, Amit, and welcome to the show. We have this first query for you, which is from Pallavi Rao, and she is into a private job, and she started an investment journey in 2017. You have the funds detail, but then I'll just give you some more details on her large cap stocks, that is direct equity. She has around 11 lakh. PPF, she has the investment amount of 7 lakh, FDs of 12 lakh. She's also put some money in her her husband has some property of 13.5 lakh in commercial. That's a commercial property she's talking about. Her portfolio has the portfolio value is around 4.7 lakh, and 6 funds, if I'm not wrong, and these SIPs are mostly from 2020. That's when they started. Yeah. Amit?
Yeah.
She wants to know about her portfolio and maybe her fund mix.
Sure. So my first question to Pallavi is that how come she's not contributing towards the household expenses? She has written that she doesn't contribute, she does only investments. So from the couple's financial planning point of view, my first suggestion is to have an understanding with respect to expenses as well as investments contribution by both the partners. Because in the eyes of Income Tax Authority, you are two separate PAN numbers, and you should take the advantages of tax deductions and investments on the basis of your contributions. In terms of portfolio specifics, Kavita, I would say, given her numbers that we have, she has about 32.5% equity allocation through stocks and through equity mutual funds. She also has 39.42% fixed income allocation through her PPF and fixed deposits. And she has about 28% in real estate as an allocation towards a commercial property that she's talking about. So if she is in a 30% tax bracket, I would suggest she can move money from fixed deposits to debt mutual funds. Debt mutual funds are more tax efficient if you have a holding period of more than 3 years than fixed deposits. Plus, they might get you about 50 bips extra return if you play it out well, given the risk reward ratio it carries. Then on the mutual fund side, I would suggest she's more into direct stocks and less into equity mutual funds. We don't have information about her experience and about how she picks these stocks. So if she is relying on an expert, then it's a different decision. But if she's choosing stocks all by herself, then I would suggest to increase her allocation more towards equity through mutual funds rather than stocks, because stocks can turn out to be risky. And once she has a decent, let's say about 20-25% through mutual funds, then she can have another 10% through stocks. Fixed income allocation is fine, no suggestion, but she can take more risk if she has the risk tolerance. And the other thing I would like to call out to Pallavi is that she should definitely attach this portfolio to a financial goal. A financial portfolio without a financial goal can lead you to a lot of actions and activities in a portfolio just for no major reason, and you could be very driven by ROI. If you have a goal attached to it, you can be more balanced, more focused investor, and you can really leverage your portfolio to achieve your financial goals faster. That's my few suggestions for Pallavi, Kavita.
All right. We move on to Ejaz, and he's from Mumbai, and obviously the portfolio that he's made, Hemant, is long-term wealth creation, and he has Axis Growth Opportunity Fund, he has Parag Parekh Flexi Cap, Kotak Multi Cap Fund, Quant Active Fund, Canara Bank Small Cap, and PGM Small Cap. He wants to know about the portfolio, and he has some query on redeeming his amount and reinvesting.
Look, Kavita, I think there are two important things. What he has mentioned is that he is an aggressive investor. Of course, he's young, he can afford to be aggressive, and he wants to build wealth over a period of time. So obviously, he has built a portfolio of equity fund, which is perfectly all right. As we know that equity as an asset class is aggressive. So, if you make your portfolio very aggressive, there is no guarantee that you will get return commensurate to the kind of aggression that you show in your portfolio. So my view always is to, I think, create a balance between risk and reward. What I see in his portfolio, if I were to analyze his portfolio now, there are 2 small cap funds and 2 multi-cap funds. Now we know that as per SEBI's definition that every multi-cap fund has to invest at least 25% of the corpus in each of the segment like large cap, mid cap, small cap. So you have two funds where already 100% exposure there in small cap. Then you have two multi-cap fund where again 25% each is invested in small caps. So I believe that there is a lot of aggression in his portfolio. He need to tone it down a bit. I don't see any mid-cap fund in his portfolio. I think there is definitely a scope to include a mid-cap fund in the portfolio instead of a small-cap fund. Now, for example, he has this PGIM small-cap fund. He can look at PGIM mid-cap opportunity fund. Again, a high-quality fund. The fund has been performing very well. It's a good portfolio. So I think that's one change I would definitely recommend in his portfolio. As for his second query, whether it makes sense to kind of book a capital gain of 1 lakh every year to take benefit of the exemption, or you should redeem it closer to when you are about to complete your time horizon. Well, my view is if you're a long-term investor, you don't want to disturb your investment process unnecessarily unless there is a need for you to rebalance the portfolio. But just for the sake of booking capital gain, trying to take advantage of that may not be a great call actually. The reason for that is that if you book profit of, let's say, book a capital gain of 1 lakh, your redemption amount is going to be much higher depending on what kind of gains have you made. So for example, if you are in a scenario where to take a benefit of 1 lakh capital gain, you have to, let's say, redeem units worth 6 lakh rupees. So which means that there is going to be a time lag from the time that you redeem, by the time you get your money and you reinvest that money. You will definitely reinvest because that's your intent to build a corpus over a period of time. Now, the moment the money comes into hand, there can be a tendency to, if the market is volatile or if the markets have moved up, to start wondering whether I should be investing that money or not. I think you don't want that kind of uncertainty. The second is you're taking a risk of market timing. So by the time you invest your money, if the market has moved up by 2 or 3%, so the very benefit that you were thinking of taking of saving some capital gain, you would actually end up buying at much higher level. So my recommendation is not to get into this practice. If you need to rebalance your portfolio, by all means do that. Now the rebalancing can be from the asset allocation point of view and also within an asset from large cap to mid cap or some such thing. So I think if it is to be done only for rebalancing, please do that. But again, not every 6 months and 1 year. But I don't think the tendency of booking profit every year just to get the benefit of 1 lakh tax exemption, I don't think it's a great idea. Should stay away from that.
All right, a quick portfolio check of Rahul Pandit. Amit, you've got the fund's names. Now his goals, he looks like he's lined up his goals really well. So he needs 1 CR by 2037, 1 CR by 2040, 1 CR by 2042 and 1 CR by 2045. 4 crores, and that's the timeline for you. You think the kind of investment he's doing, he'll be able to achieve this?
So Kavita, I'm looking at his portfolio and the numbers. So to achieve 1 crore in 15 years, he needs an SIP of 18,000. Then to achieve another 1 crore in 18 years, he needs an SIP of 11,350. And then another 1 crore in 20 years, and he needs an SIP of 8,500. And then another 1 crore in 23 years, he needs an SIP of 5,600. All this adds up to about 43 to 44,000 rupees SIP on a monthly basis. He has chosen good equity schemes. I don't have any changes recommended for his portfolio. He's doing well, and he has taken good performing schemes. And based on annualized assumed rate of return of 14%, I am suggesting that he needs 44,000 of SIP, and he's doing 24.5 thousand SIP, which means he's short by approximately 20,000 a month. So he can tone down his expectations or the goal amounts, or he can deprioritize one of his financial goals, whichever he thinks is possible, related from the allocation to large cap, mid cap, multi cap, and also small cap. He has not gone overboard with any particular market cap category. So he has a balanced portfolio, and he's taking full advantage of equity allocation completely through his set of mutual fund schemes. So only expectations he needs to reset about himself is how he can increase the SIP or reduce the financial goal target amounts.
All right, last query of the show. And Hemant, this is from Leona D'Souza. She says that she's a homemaker without a lot of experience in finance, and her family gives her monthly expenses, which she saves. And now she wants to start her investment journey, and that's the cue for you. How should she go ahead?
Well, my recommendation is if she really wants to start her investment process, is to look at mutual fund as an option. Because there are many advantages of investing in mutual fund as compared to other options, be it in terms of diversification and the fact that you have professional fund manager managing your money. And the best thing about mutual fund is that there are options available for a beginner as well as for experienced investor. And if the intent is to invest for a longer period, maybe you can start through SIP in equity fund. And it's a very simple process to start. You need to do your KYC done, which you can do it online or offline. Even investment can be done either online or offline, either through the mutual fund or a distributor or through an online platform. So it's very simple to kind of start your process. Two funds I'm recommending to her. One is Nippon India Large Cap Fund, because again, I think it's again important to not make portfolio very aggressive. And the second is Kotak Equity Opportunity Fund, which is a large cap and mid cap fund. Both these funds have long established track record. Begin with this, begin with a small amount. It'll make you a better investor over a period of time. Once you understand the nuances of investing in equity and equity funds, maybe you can increase your investment, but begin with mutual fund. I think that'll be the best option.
So that's the recommendation for Leona, and that will be all on the show today. Thank you so much, Amit and Hemant, for participating and giving your recommendations to our viewers for their financial portfolio. And with this, it's a wrap on the ET Money Show. Thank you so much for watching.